Guys, 2022 has been pretty tough for investors, and I'm really glad that we as real estate investors are pretty much the one asset class that is still standing and has been doing pretty well. But today on our show, we have Roger Curry, and he has developed an amazing system that helps to forecast how will equities actually behave. Not very long term, but more in the immediate, so you can make small engagements and almost never lose anything because his system is 80 to 90% accurate. So he will explain how that works and why that could be very beneficial, especially now that markets are down quite a bit. So listen to this show, watch us on this show, and enjoy. Hello and welcome to the Ideal Investor Show. Today we have a great guest. Roger Curry is with us, and he has the Market Forecasting Academy and is mainly focusing on equity markets. And we want to discuss with him a little bit today what we can see in the markets, what we have recently seen, and what he can help forecast and look at and better understand what's going on in the market. So Roger, welcome to the Ideal Investor Show.
Thank you, Axel. Great to be here. Thanks for having me.
Wonderful to have you. And I looked at your website, but obviously our audience members don't necessarily done that before they tuned in. So can you give us a little bit of a synopsis how you came to build the Academy and your mentoring program and what you're doing now?
So I had about 14 years of frustration buying every possible education and training program I can get my hands on that was legitimate, that was credible to help me achieve my goal in the financial markets, which started back in mid 1990s. But I wanted to be able to kind of have a laptop and not be geographically tied to anything, just have an internet connection, be able to generate cash flow and build income and build wealth that way. Well, no matter what I did, I would always find myself making some money, having some success, and then something would change in the market's environment. And then whatever I was using that I was taught suddenly start to work inconsistently or poorly or not at all. So then I found myself being stuck looking for the next new thing, right? And I did that for 14 years. And it turns out that's really the nature of the beast. Even the professionals in the market are always kind of constantly chasing what's the next new thing. And today it's AI and machine learning and all these things. Well, all those things have a very limited lifespan simply because the market's always evolving and never really the same as it was before. So that's going to cause people to always have this roller coaster hit or miss experience. Well, at one time, I think something had happened and I snapped. And I thought there's no way, there's got to be some way that this has to work, because there's no other industry where you go and learn a skill set. You have to keep going back to school for it. You learn how to be a doctor once, you learn how to fly an airplane once, you don't keep going back to school. You know what I mean? So I thought something's wrong. So I threw everything out and I had an epiphany one day. And if anyone goes to the website, there'll be an opportunity for them to get my Financial Markets Manifesto. And I'll talk about the story where a group of 17 surfers changed my life that day. By just observing what they were doing, I had an epiphany that I carried back with me to the markets. And I thought, I saw something that made me realize there was 2 out of the 17 that were behaving differently than the group. And the group kept kind of taking wave after wave and crashing and burning. But these other 2, after about an hour and a half, I realized they had some way to filter out which trades were not likely to give them a bad ride. And they weren't taking wave after wave. They take very few waves. But when they took a wave, they surfed that. It was a very nice surf. It was smooth. And I thought, those guys are the professionals. And I realized, what if instead of looking for opportunities to make money in the market, I could look for opportunities that were not likely to lose money instead? And that began me on a whole different trajectory. And I ended up developing an analysis model that allowed me to see demand in real time in the market. Now, what's interesting about that is most people focus on what price is doing, right? Or the fundamentals and the earnings reports or technical analysis. But there's actually 8 different major factors of demand that impact price. And when you combine them together and see what their aggregate combined impact is going to be on price, suddenly you have a clarity on where the real-time demand is in the market. And look what happens. When you know where demand is, it turns out demand is a leading indicator to price. Price lags behind demand. So think of what causes prices to go up and down, even in real estate. It's where demand is, right? As demand grows and expands, prices rise. If demand decreases, right, or contracts, then prices come down. Well, these cycles happen throughout the day. Demand's always fluctuating in the markets throughout the day. And so I learned that if I can see where demand is in real time, then I know what to expect price is going to do. And I did that originally for myself, and I was able to accomplish my goals very quickly early on. And when I did, guess what happened to me? I had an abundance of time freedom. And that was what drew people's attention to me. He said, it's been months. I just see you always socializing, volunteering your time. How is it that you're always free when everyone else was working? I would tell them, and suddenly people would begin to ask. And it started with people from church, actually. They would ask, would you be willing to teach my son or teach me? And I used to teach Sunday school, so I love teaching and I know how rewarding that is. And I thought, yeah, why not? And that began my experience of teaching and training and building a curriculum as more and more people came to me. I think 90% of my clients are all word of mouth referrals from existing clients. So that's what got me started. And that's how I built the mentoring and training program, which I take great pride in. I take personal care and attention because it's just something I really enjoy.
Yeah, absolutely. Great. Thank you for summarizing that so nicely, Roger. And I think we are kind of alike in that way because, for us, I would say most of our mentoring clients are also through word of mouth or because they read something or heard something, maybe on a podcast or an article or stuff like that, and reach out. And yeah, obviously on the website, just like you, we have the opportunity for people to set up a call and say, hey, let's just see if we click, if we align with each other. Now, one thing I thought was very interesting, you spoke about demand and that there are all kinds of different dimensions, but I think it might be worth clarifying. Are you talking about demand for a particular stock that you can identify, or are you talking about the demand for the kind of business or products or services that those companies that the stocks are actually available to buy or sell are actually creating?
That's a great clarifying question. So actually, it's each and every market, every asset class, every symbol. So actually, you mentioned that we focus on equities. Actually, we are agnostic to what market we focus on. Equities is something that's very popular for people, but we, whether it's commodities, crypto, currencies, a lot of people like to trade options. So really anything, the futures market, indexes, it doesn't matter. But each of those markets and each of those symbols within those markets have a number of demand factors that are affecting and impacting that price. Mm-hmm. So most people will be familiar with fundamental analysis, technical analysis, and their various subsets. But there's actually 8 different major factors. So we've got, besides fundamentals, we have geopolitical impacts, right? And that includes central bank macroeconomic effects. You've got volatility and the different shifts that it goes through. You have, of course, market sentiment. That's a factor that affects prices. Sometimes people just all of a sudden hear something about somebody and they decide they want to sell, and it has nothing to do with the company's earnings or products or anything. And so that can create a double-digit loss real quickly. You've got liquidity levels, which includes volume, order flow, trade flow. Then there's something called prime liquidity pools. These are areas in the market that are very easily manipulated by bigger institutions who have the financial power behind them to actually influence the market up or down within an area. And it's important to be able to acknowledge and recognize, look, that is happening, and that I need to know how to take that into account so I don't become a victim of that manipulation and be taken advantage of, right? So there's a prime pool of liquidity. Then you've got imbalances in supply and demand. And of course, you have technical analysis, which includes Fibonacci, Gann, Elliott wave, and all these things that people like to use. Well, when you take the combined impact of all of those together, which is what I've done with my analysis, and of course, that sounds kind of like it's complicated, but actually what I did is I streamlined all of those into a simple indication that kind of acts like a fuel gauge. If you can imagine in your car, there's a bunch of moving parts and things that kind of determine how far your car is going to go. All you have to do is really look at your fuel tank, right? And say, oh, I have a quarter of tank of gas here. And I know I have a 250-mile road trip. So a quarter tank of gas, instantly, you don't have to go look under the hood. You don't have to read the owner's manual. You know instantly that is not going to take you 250 miles. So it helps guide your decisions with total objectivity and total clarity. It's not something that's subject to someone's interpretation, right? You get a pretty good feel. So that's what I've done with my analysis. So it's actually very simple and visually intuitive like that. But it takes into account all of those factors. And then now look what happens. I like to use a rubber band analogy. A lot of people are used to seeing an opportunity and they go, here's an opportunity where this thing's likely going to snap back, right? The problem is it looks good. It looks like it's kind of stretched out. It looks like it's going to snap back. The problem is there's a lot more room for it to stretch even further. Right. Okay. And so what's important is for people to know, well, if this is the demand right over here, I don't want to take advantage of just every opportunity I see because that's going to give me a hit or miss experience. But if I can have a process, which is what I've developed, to analyze and know when the market has such a significant imbalance where price is so far out away from where demand is, it statistically has no more room to go further away from demand. It has to come back. That represents a low risk, high probability opportunity to profit. And I call that demand imbalance arbitrage, because we're arbitraging the difference between demand and price when there's a significant imbalance and there's an unlikely scenario that you're going to have a bad experience. Does that make sense?
Yeah, that totally makes sense. And that's a great analogy to use. I have two quick things that I, at least for my own education, would like to ask you and learn from you, but I'm hoping that the audience is maybe curious about that too. You talked about markets a couple of times. And then you said one of the 8 things is sentiment. And what I've been kind of wondering about is, and I'm kind of paying attention because I think as somebody who is mentoring and helping other people using their funds and their money for investments, we have kind of like an obligation to keep a big picture in mind, even if we focus on a particular area like our residential real estate investing. But when you talk about markets and sentiment, I'm really curious because when I see, for example, these Michigan University sentiment index and stuff like that, to me, that always sounds like they're doing a survey in business, but also with the public to find out what is kind of like, to the extent possible, the sentiment of the public and the business community. And then when somebody says the market, now obviously all these people, whether they're businesses or individuals who are answering that survey, are in a sense part of the market. But then I'm oftentimes wondering, well, is it that broad market or is it basically the stock market where I'm oftentimes not so sure? Is that really in the majority businesses and people who invest, or is it actually institutions and 401k plans and pension funds and that kind of stuff? So can you clarify a little bit what is actually the market in this point when you say market sentiment?
An excellent question. So this dives into the multifaceted aspect. There are subsets to each category that have to be taken into account. It's not as simple as looking at a market sentiment indicator because, like you correctly assumed, that can be very skewed and not a very accurate perspective of really what's happening in the whole. It could be a very small swath of people that may be even framed to look a certain way for some reason, right? So you think about when you buy a diamond, you never look at just only one side of a diamond. You look at all the different sides of a diamond to ensure that it is actually of high quality.
Not that
right?
I'm buying diamonds that often, but I believe you.
Okay, there you go. So what you'd want to do is when you look at market sentiment, you want to look at the different factors and data outputs that we have that reflect market sentiment. And then what you want is to layer up on top of each one of those institutional as well as the individual impact, right? As well as you've got professional, you've got non-professional, that's multifaceted. So as we look at those different data points, we bring them together, then the margin of error becomes a lot less. And so then now you have which is why my analysis has consistently, we say there's a minimum since I developed them since 2010, it's never had less than an 80 to 90% level of accuracy. So there's that buffer, there's that margin of error of 10 to 20%, right?
Yeah.
And so, but when you combine all these together and all of those categories each have subsets, now you have a 360-degree view, right? It's a very holistic view of what's going on in the market. Now, when you have that accuracy, it provides the consistency, which drives your confidence, right? Through the clarity that you have on what you're looking at. So your decisions are, you know that you can make confident decisions with consistency where you're right 8, 9 times out of 10. You're never having to take big risks. You don't have to hold on to large drawdowns anymore. In fact, this very analogy, if you think about it, when you see price at a high and demand, here's demand right here. Okay, so let's say this is demand. Okay, when you see price up here and the analysis shows you demand suddenly shifts this way very quickly, well, look at how outstretched price is. You know that price within a day or 2 or 3 is going to have to snap back and catch up to where demand is. So we know we've got a double-digit correction or a crash coming before it occurs, because demand always moves before price has a chance to figure out, oh, demand has shifted. It begins to follow. And once it follows, the further away from demand price is, the more rapidly it will accelerate down. Now, if demand just kind of does this, price can kind of follow slowly. But if demand does this, like what we saw in the coronavirus crash, we had a time where the market went up, made a new high, and demand was kind of just around underneath price. And then when it went up a little bit more. Demand now is like lagging. And then when price pulled back, demand actually did this. It went significantly lower, unusually lower, like in a significant way. We knew that this market's about to crash. And I think it was within 1 or 2 days after that, the market crashed significantly. So even crashes no longer have to become a surprise to you once you understand that we have to take advantage of all of the demand factors and understand where real-time demand is. So that way we're not really chasing our tail and being surprised by these seemingly sudden moves. I mean, think of it this way, Axel. If you and I can't walk under a clear blue sky and suddenly have it start raining and lightning and thunder, we're going to see clouds, you and I, forming in the horizon and coming towards us and getting darker and more ominous and see thunderheads. So guess what we just did? We've just identified that there are factors in the environment that we can identify, but more importantly, they take time to build. They don't just suddenly show up. And that's what makes them forecastable. But the problem that most everyone has in the market is they've been limited and used to watching and looking at 2, maybe 3 factors out of those 8 that I talked about, primarily fundamental and technical, maybe some news. And they're left to be blindsided by 5 to 6 other factors. And that's where you get a lot of the hit or miss experiences. And that's why I've built a reputation on consistency. People know me for consistency because we have a very clear and complete grasp of what we're seeing in the markets, no matter what market.
Yeah, absolutely. And I think, I mean, the beauty of what you're doing, even if you take the lower end and say, okay, you're going to be right 8 out of 10 times, but if you equally spread, if you were to say, okay, throughout the year, I'm doing $1,000 a month just as a number, right? And 8 out of 10 months, you're going to be right and make a gain. And 2 months, you might not. You could argue, okay, the loss could be a little higher than the gains. But if you're winning 8 out of 10 times and maybe sometimes even 9 out of 10 times and better, then I think you're going to have a good year every year, right? Now, there's another curiosity, and you're the perfect guest to ask those things. I apologize if I'm
this is great
in a little bit, but so one thing that we are very used to since basically the 2008 financial crisis crash is that I believe my interpretation, and this is literally, I mean it very literally when I say interpretation, because I'm not going around and doing empirical studies or stuff like that. But my interpretation is the government basically put much stricter rules on lending for real estate investing, which now I think 10 years later, we find out that's actually a good thing because these crazy things that, you had some sort of fog on the mirror and you could get a mortgage, that went away. And I think a good thing. It put restrictions on all the kinds of things that you need to prove to be eligible to get a mortgage or be an investor, which sadly ends up into a 100-page closing document, 200 sometimes. But what I also believe what happened in our market that we're specializing in is that both the builders who got burned and the financial institution became almost simultaneously more careful, which for years after the crisis and working through all those foreclosures, in my way of thinking and looking at it, led to the fact that way less inventory was created for people to actually buy real estate than just the population growth in general would have required. To the point that we are now at a point where we have, in my interpretation, around 10 million units missing. Some people say 6 million, some people say, but I believe somewhere in that area. Now, why am I describing this? What surprises me, and I fear that like real estate, especially residential real estate investing, and if you look at the different assets, right, like gold didn't do anything, even though we have crazy inflation. Silver didn't really do anything. Stock market for 2022 is probably the first 6 months to start a year in a long time. But the bonds are crazy too, so you can't go there either. Now, if you do shorter term view, then you can still benefit from the ups and downs. But if I look at, okay, somebody who came to us like 2, 3, 4 years ago and has worked with us along that path towards the time freedom point in residential real estate investing has been doing and continues to do pretty well, especially compared to the other markets. But this point that I was getting to about these probably, I think, 10 million units capacity lag has probably helped this a lot, that we even have still increasing prices, increasing rents and stuff like that. But when I look at the stock market side, and I take an example, during the pandemic, Amazon was actually a prime child to say, like people basically needed to order online, and Amazon tried their very best, and I think amazingly successfully getting stuff to people. Actually, to the point that my wife sometimes lately says, why is this taking 3 days? I said, well, because you've gotten so used to Amazon having it to you
That's
next
right. We
day
get
or
spoiled.
2 days, right? Like, and I remember times when it took like 4 or 6 weeks to get something that you
Yeah.
ordered, right? So, but the point is, so they did really well during those last 2 years. And another capacity similarity that I see is somebody like Tesla.
Yeah.
Right? Like Tesla basically has orders up the gazoo and they're building as fast as they can production capacity. But when you look at what happened in our market in real estate, which is you could maybe argue that we're reaching a plateau. But when you look at like any kind of what they consider technology stocks or stocks like that, like Tesla, Amazon, or Google or Facebook or stuff, even though there is the demand, and this is trying to get a little bit more the head wrapped around this idea, they are not the same like many others, like in the S&P 500, who probably gonna face some really tricky times if they're not already in the middle of it. But then there are, especially Tesla is for me a crazy case. How could they have lost 30% when they can't make cars fast enough and they're selling literally every vehicle they make? How does stuff like that come together? I know that you're normally not necessarily looking at this longer term, but to me, I'm trying to make sense of things that I see when there is so much demand that you cannot, even if you work at max capacity and you're building new factories and stuff, and you can't meet the demand. That in real estate we did well. In the stock market, everybody got kind of hit.
Yeah.
I don't want to say crushed, but I mean 30% in 6 months for an organization that can't make enough of their product. I don't get it. Maybe you can you can give some.
One of the most beautiful aspects about this is the way I've structured my analysis model. Originally, was for me. I never like to do more work than I have to. So I always figure out ways to just, okay, how can I streamline this? And so I figured out a way to detach myself completely from the need to even look at news or follow what's going on around me, because everything I need now is able to, thanks to the internet, I'm able to pull the data and combine it into that aggregate little visual indication that shows me kind of what is the aggregate combined demand for something at a particular moment in time. I was just invited to speak at an event just last week, actually, and I gave Tesla as an example because you could see Tesla very clearly when you look at, and I was showing him a very kind of an oversimplified slice of my analysis. It takes like 4 to 6 weeks to learn the analysis because it's a skill set you'd learn. Right. But from a very simplified perspective, I showed how my little indicator down the bottom that shows me real-time demand showed that demand had shifted 30% below where current price was. So you had multiple days where you had enough time to actually either take a defensive position or get out or lighten your load or take a short and profit on the way down. But you knew demand had shifted and you had about a 30% push. So when it was up at 1,000 plus, you saw that demand had shifted to somewhere in the 700s. And so having that kind of access to being able to analyze the market in real time and do it in more than a few minutes, it is so empowering because you realize I no longer have to worry about these long-term cycles that they're so far out I can't control. I mean, if you think about forecasting poor weather, the further away we are in time, like if it's a week or 2 weeks out, that weather forecast, it can work out 50-50. But when we have a weather forecast for poor weather in the next 24 or 48 hours, that's a much higher probability forecast, and we can be prepared. And so when you have analysis that gives you this real-time, accurate insight to what's going on with demand, that allows you to become very efficient. And in fact, you actually start to move away from speculating on the outcomes to becoming truly an investor in these very short time frame cycles that allow you to have an efficient in and out. And here's what happens. When you're able to actually spend just an hour and a half, 2 hours, either in the morning or in the evening or whenever you want, and you do that 4 or 5 times during the week, right? You talk about 10 hours a week on the low end. That can give you a very consistent experience of what's going on. And you can see pockets where you can go in, take advantage of these significant imbalances, profit from them, and be out and be done. Guess what that does? That allows you to rapidly compound your account with consistency, right? And we never take, by the way, just so you know, our downside exposure risk is never more than 2% or less of our account capital, whatever we're investing. So it's very, very efficient. But what you're doing is you're starting to rapidly outpace the market and outperforming without the stress, without the risk, and without the time consumption that most people think. You're not glued to your screen, and you no longer have to worry about how that demand is going to impact that particular symbol or stock or commodity, right? Or currency or crypto. It doesn't matter because now I'm just operating within the cycles that are very clear, very objective, very obvious, just like my fuel gauge. I got a quart tank of gas. I know today I want a 250-mile drive. I know exactly what to do. And that takes all the pressure and the stress off. And so my approach really is very different than what we fundamentally have been taught to do when we come to the markets, right?
Yeah.
And when we think buying and holding is safer, more conservative, actually, when you put this model up in front as a contrast, buying and holding becomes more speculative. This becomes much more of a controlled way to both experience the market as well as perform.
Yeah, and that's actually a great segue. Before I dive into that with you a little bit, I believe one of the aspects that comes to my mind is when somebody like you has developed a system that is basically not really dependent on emotions or what people think about stuff or so forth. The conviction, so to speak, that people need to gain is that they actually trust the system.
Yes.
Without necessarily questioning, is this the right industry or is this the right asset class or stuff like that. And I admire you for being able to convince those people that actually work with you to say, okay, step back from the individual asset that you're looking at and let's look at the system and how truthful and how unemotional, if that's the right
way. It is, you're right.
Right?
It's unemotional.
The system is, right? And so if you can develop the necessary trust, it doesn't really matter that much anymore. But why I said it's a perfect segue in a sense is also for what we are doing. And when you said, for the long-term aspect is there is, in my view, a really important distinction between something that you buy that consistently performs with cash flow versus something that you buy where that in and of itself, whether it's a stock in a certain industry or a gold coin or a crypto coin or whatever, in and of itself has to increase in value. The beauty in what we are doing, and I always keep pointing this out, is yes, we obviously love it when we build equity because housing prices go up and we could theoretically either tap into it with a home equity line or we could refinance it and get cash out and stuff. But even if none of that happens, as long as the purchase decision at the beginning was good for a well-performing asset that has positive cash flow from day one, and a very high likelihood that that is going to continue to increase because people will probably over time pay more rent rather than less. I have at least not ever seen that rents came down any significant for any longer periods of time. So that's very different than saying I'm basically betting on the asset itself gaining value because then I can basically realize that increase in value. So with those kind of things, I know that you said when we first talked, this whole idea of reaching the time freedom point, I would like to give you a little bit of an opportunity to put your spin for for the Forecasting Academy, but also how you work with your people in a similar sense to reach this point that you said you reached very quickly, to be able to say, okay, maybe 10, 12, 15 hours a week. And in some weeks, I can just let the machine run and do my thing, right? Can you describe a little bit how you do that with your clients?
Yeah, well, this is one of the things that I love about your time freedom point, which I really admire your focus on that to help people get there. And that's really one of the reasons I was so excited to do this program with you today, because generally, a lot of people will come to me with the wrong idea. They've been sold a lot of good ideas in the market. They want to trade for a living. Trading is very speculative.
Yeah.
But when you come at it with an investor's perspective and you want to apply demand and balance arbitrage is one of the most conservative, most controlled, any kind of form of arbitrage. It's very, very attractive because it tends to be very low risk, very controlled, very high probability outcome. So, but it used to take massive amounts of money and structure to do that. Well, now because of the internet, data, and we can do it very efficiently from our computer, right? This little thing is a 13-inch monitor laptop. And I keep it next to me because it reminds me where I came from and what allowed me to accomplish my goals so early on that people are like, wow, how do you have all this time freedom? So what I encourage people to do is don't come to me and seek to trade for a living. That's not a healthy goal. What you want is to use this application of trading, investing in these cycles. You're always trading your money for the opportunity to make more. So that's what we call it trading, but not in the speculative sense,
right,
but from the investing sense. Well, what I tell them is I want you to use your 10 to 15 hours a week that you're committing, whether it's in the morning or in the evening, because of the consistency, to compound your account so that your trading income replaces your full-time income, whether it's from a business or a career, whatever you're doing. But don't stop there, because you can do that very efficiently over a 2, 3, 4, 5 year period, depending on how much capital you start with. Okay. Once you've replaced your primary income with trading, don't stop. Increase that so that the abundance of the account now goes into passive yielding investments, usually what you're focused on in real estate that has very high quality returns or high quality assets that they're going to produce a nice return that's not going to be filled with headaches, right? And now you want to build your passive income to replace your need to even have to trade. So that way you're only coming to the market because you want to. From day one, it's always, I want to come to the market. It's an enhancement. I don't need to come to the market. So I actually put people through an application and an evaluation process before I take them. Why? Because I think it's intellectually dishonest to just open this up and make it a home study course so I can focus on me making millions selling my course. I'm not, thank God, I'm not in the place in my life where I have to do that. So because I never intended to teach this, it kind of came to me, fell in my lap, and I just found tremendously rewarding. So I enjoy it. Right. So it's a win-win-win. So instead, what I do is I take the time to respect the person the way I wish I was respected, and I treat them the way I wish I was treated. And so I say, let's look at your situation. I want to make sure there's no pressure. They don't come to me, they're desperate. They don't need to trade. They want to trade, right? Then I know that their life represents a certain circumstance that is conducive for them to actually apply this with success. Because when they come to me, if they don't have that pressure, they're more apt to follow directions. And what I do is I say, look, you don't have to trust the methodology. You don't have to trust me. Just use common sense. Look at the track record. You don't see any negative reviews or complaints where I've disappointed somebody. I've always delivered on my promise. So now what I want you to do is prove it to yourself. So then I make them go through a series of where they're applying it on their own. Because we're forecasting the market, we can't fake that. You either know what's going to happen next or you don't. And you have to show me and show to yourself that you're at least right 8 to 9 times out of 10, and you've never taken big risk, right? And you've never taken hold on to large drawdowns. When I see their performance is built, what has happened? They've built the confidence. They've built a new habit. They've proved to themselves in a safe environment on a fake money account. And everything's real except for the money. And then we start them off not with the full capital that they wanted to use, that they have in their mind to use. We start with a small fraction to test their ability to, can you still remain true to the process? Because the process is what delivers the results, not making some goal that I'm going to do something per day or per week, but that I'm going to show up and just be a steward of the process. And it's going to deliver to me what it's going to deliver to me, right? And when they do that, now there's no emotion, there's no stress. It becomes a form of relaxation for many people, and they're enjoying what they're doing. And that is what is sustainable, when you can enjoy it and it's not pressure filled. But you think about if you're under pressure doing anything, you've driven a car most of your life, so you know how to drive a car. But if you're under pressure to drive your car because you're running late to a very important appointment, you'll drive that car more aggressively. You drive differently, and you're more likely to get into an accident, get a ticket, possibly a life-altering event. This is where people don't really respect the markets the way they ought to, and they don't realize that. So there's a wisdom to my approach as well, but it absolutely plays into what you are trying to inspire everyone to do, is focus on the long game and not the short game. Don't say, I want to just do this. Say, hey, this is going to be a stepping stone to the next thing, and that's going to be a stepping stone to the next thing after that. And what's that? I want to set myself free, set up a financial moat around me where I never have to be going to anything with any need or pressure to do it. It's an enhancement until I've built that passive income. Now I can do whatever I want to do. Whatever extra trade or anything I take in the market, I can splurge. If I want to take a trip on a private jet, I don't feel guilty or bad. I'm not taking it away from principal capital, or I'm going into putting it on a credit card. No, it's extra. It's an abundance. That's, I think, really smart when people can think long-term, make a little bit of a short-term sacrifice for longer-term rewards and benefits. That's wisdom. Right.
Yeah, absolutely. I'm totally with you. And I think we are very aligned in that sense. The other thing that I also oftentimes point out, and I'm assuming you would agree with that as well, is there are certain things that you can be passionate about. Like, I give an example for myself. I love, and this, my dad liked it for relaxation. My first job that I ever had was working in a nursery to grow stuff from seeds for the owner of the nursery. So that kind of very early got me, and I'm still loving to do this, but I'm not putting any kind of seeds in the ground or grow anything to make money with it or so forth, right? It's really for the joy. And I really have to say, just as this one example, the most joy is actually when something grows. Like just the other day, our neighbors came by and we hadn't seen them for a while. And I don't know, I'm lucky this year and I got a whole bunch of really big zucchinis. And I said, hey, Teresa, hold on real quick. Would you like some zucchinis and some cucumbers? And she said, yeah, absolutely. If you have too many, right? So organic or, never seen a pesticide or anything like that. So I put a few in a box and gave them to them. And that act of just giving them away and making somebody smile and be happy, in addition to growing some stuff. But that's just one example where if you say, okay, my investing stuff works, whether it's in real estate or using your system, and I can do this. Or somebody might say, okay, I want to pursue art. So I want to make music. I'm not going to become a big star. It's just something that I enjoy doing, not for the money, but for the enjoyment. You can do all of those kind of things when you no longer have to worry, how do I actually cover my life expenses or go on a vacation or anything like that. So I think there is a great amount of alignment. Now, coming to the end of our show, as you know, I always ask pretty much the same two questions. So the first one is, if you could meet anybody, Roger, that past or present, who would it be and why?
It's interesting. That's a great question, and I've given that a lot of thought. And quite honestly, I think the person that I would most want to be able to meet and learn directly from, this is probably going to surprise you, is Jesus Christ. Just because of his ability to be so calm and clear, and the wisdom that I can imagine I could glean from someone who has that. That's something I've been very passionate about. And it's just, I'm always searching for what is going to give me peace and balance and a joy that seems to bubble up rather than just a happiness. Where happiness, if you think of happiness, the root of happiness is happenstance. It's not consistent, right? But joy can overflow and it can be just lasting. It took me most of my life to figure out how to do that. And a lot of the principles were learned from just me really focusing on biblical truths and things like that. And that's I would say that would be my person.
Yeah, that's definitely a cool choice. And if you get to do this, by the way, I would be curious to find out how much of all the stuff that we basically read in the books and see in the movies and in historic records and stuff, how much or how accurate that actually really is. Because I'm sometimes thinking, wow, that's on the one hand an interesting story, sometimes a crazy story, all kinds of different interpretations. But how cool would it be if Roger were to go there and verify, right? Like, so
that's something. Yes, that's an amazing.
The other question is, and I'm lately starting to preface that a little bit, you're not forgetting everything and you can come back. But the second question is, if you had a time machine, you could go forward, backward, wherever you want to, and you can come back, like I said, where would you go and why?
I would literally start my journey knowing what I know today, right back when I started in 1996, I think. So actually, whatever I developed in 2000, the methodology developed in 2010, if I had somehow come into that or figured that out, I wish someone would have taught that to me. But I would have loved to start in 1996, because in 1996, when the market was still just taking off, the market moved much more efficiently, much more orderly. The opportunities were far greater, and I could have been far more productive. One thing that's interesting about where we are now with the market, which is why I would have loved to take a time machine and go back then, is, when the market becomes not very conducive to interact with, if it's a poor market, you won't find us, my clients, losing more. You'll just see us actually engaging the market less, because it acts like a risk filter. And so It keeps us away from things that are not going to really help us accomplish our goals with at least an 80-90% accuracy. So it will become less active. And I think that's difficult for most people. People want to be active. So it makes it hard when I have to sit and say no and be inactive. That takes a level of patience that really has to be exercised. But of course, patience is not a bad virtue to practice to begin with.
No, absolutely. And I think that's another similarity that we have. When I first started my mentoring program and my own investing and things like that, pretty much after the last big financial crisis, whether you were lucky enough to be sane enough to already be there when all these foreclosures were in the market between 2008 and 11 or so, or you started after that, you basically had a pretty broad spectrum of opportunities. You could say, okay, I do flipping, or I do wholesaling, or I basically buy renovated properties from turnkey providers, or maybe I get involved in a syndication, or maybe I'm looking for hooking up with a developer who wants to develop a new development in an area that is up and coming, things like that. And if I look at that evolution, I would say right now, the times we are in, especially after we had this huge ramp in the last few years, is prices for houses that are freshly renovated compared to the ones that are new build, they're almost on parity.
Yeah.
And so this whole segment that we used to basically spend our investing money, regardless of the cost for financing, is basically dormant right now.
Yeah.
Because I'm the same like you. I'm saying, okay, literally put yourself in the shoes of your tenant. Even though we're not doing this ourselves, we have property management doing it for us. But fundamentally, if you were a tenant and you get a freshly renovated 3-bedroom, 2-bath house that was built in the 1960s, or you get a brand new house that just finished being built, which one would you go for if the price were similar, which is currently literally the case? I mean, there are some variations, but it's very minor, right? And almost everybody would agree, yeah, if I could live in a brand new house with all the brand new everything versus something where somebody brought it back, but it's still a 1960s, 1970s house, right? And that's basically, why I'm saying, okay, we have to be patient. We have to find the right deals, but we also have to acknowledge that certain market segments need kind of like a little bit of a recovery, not in the sense of going down in value, but before they become attractive again and meet our criteria. Yeah. So, well, one thing I applaud you for what you said as far as where you would go with the time machine. I always have to say, since we need to maintain the time-space continuum, you could only tell people to teach, have that epiphany like you had with the surfers, to teach this stuff so that more people would know. Because I think we both agree that's really the saddest part about all the work that you and I and others like us do, is that we have to do so much of this work because the kids don't learn any of it in school. Yeah. Right. That's actually the sad part. I wish, you and I and most of our guests, we could all go together, like, I don't know, 50 years back and say, can we somehow infuse the seed in the teaching community to teach this stuff? And how much better off would we all be?
That would be golden.
Right. But since we can't, we have to do what we have to do on a daily basis. Roger, it was awesome to have you on the show. Now, if people want to actually go and figure out if the Forecasting Academy is for them, what do they need to do?
So I actually have a little mini course primer. It's the educational training that I provide complimentary at marketforecastingacademy.com, which gives them an opportunity to also download and read my Financial Markets Manifesto, which shares some of the stories, some insights, and really enhances their journey and their experience through the course. At the end of that course, they'll know everything they want to know or need to know about demand and balance arbitrage and the methodology, people's experiences. They want to see what it looks like, how it's applied, all that stuff. They're going to get all that training complimentary. And if they want to apply and do an evaluation, they're welcome to do that. I really like to respect the individual, but I really like to get to meet people, and they meet with me personally. It's not something I delegate out to people. I'm not in this for the masses. I really want the relationship. I'm nurturing a community of people that I enjoy. And so that's the easiest way for them to really get to know everything they want, is Market Forecasting Academy, and get the course and enjoy the journey. See what
That's awesome. Thank you. And Nadine will put that in the show notes so that everybody who is listening or watching us can actually find that and then go there and do exactly like you just explained. So Roger, again, thank you so much for being on the show.
Thank you.
All right, then.
It's a pleasure to be here.
You can do it again soon.
Appreciate it.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.